Figuring out what interest rate you'll qualify for is no easy task. I often have people call me asking me questions like, what are your rates? It's similar to walking onto a car lot and asking a salesperson, how much are your cars? It's going to depend on the features, the make, model, etc. The same is true for interest rates. The interest rate and the cost of that rate that are offered to you are going to depend on the specifics of your loan criteria for your individual situation. Details such as loan size, credit score, the amount of your down payment all go into determining what terms are offered to you. There are what's known as loan level price adjustments, or LLPAs, in the mortgage industry. These are basically risk factors that affect not only the interest rate, but the cost of each rate to you. Higher credit scores with higher down payments are obviously going to be lower risk loans, so there's going to be fewer of these loan level price adjustments, meaning you get a better rate or a better cost of rate. The same is true for the opposite as well. If you have a lower credit score with a lower down payment, then you're going to pay a little bit higher interest rate or a higher cost for the same interest rate. And loan amounts over $300 tend to have better pricing. And you should consider that the primary purpose of the loan is going to factor in. So mortgage loans for investment properties or second homes are always going to be a little bit more expensive than those for your primary residence. Does it make sense for you to pay points in order to obtain a lower interest rate? Well, that can only be determined by analyzing your specific situation to determine the likelihood of how long you'll keep the mortgage. For example, if you were to pay $3,000 up front to save you $150 a month on a lower rate, that probably makes sense because you repay yourself within 2 years. But let's say that $3,000 upfront cost only bought the rate down enough to save you $50 a month. In that case, you may want to reconsider. Statistically speaking, most people only keep their mortgage for about 3 years. They either refinance it or sell the property. So when you do that, you do not take advantage of the lower payment that was associated with the rate that you paid additionally for upfront. So you may not have time to recuperate the cost of that upfront lower interest rate. The most important advice that I can give you is to be sure you're working with an experienced loan officer that knows how to analyze and compare these options with you so that you can choose the best option that's for you. Please reach out if you have more questions. I'm always happy to help.